Welcome everyone to the Capital Fund Law Group Real Estate Investment Seminar. We welcome those of you who are here with us today in Century City in Los Angeles, and we also welcome those of you who are joining us by live webinar. My name is Beth Ann Roth. I'm with Capital Fund Law Group, and joining me today from the firm are John Lohr and Vanessa Torres. And we also have a very special guest, Ken Cruz, who is CEO of Alpha Wave Investors, who is here to present to you as well. We have a lot of wonderful information for you today, and John, Vanessa, and I are going to start with the legal overview, and then we will hand the mic over to Ken to give you some information from out there in the actual investment world. So, my background is I started my career at the SEC. And I have worked in-house as with a large investment management firm. I've lobbied on Capitol Hill. I've worked with some large law firm groups and in fund groups. And I have found my way to Capital Fund Law Group and very excited to be here now. So I'm going to give you a brief overview of where real estate funds fit in this space. Vanessa is then going to give an overview of the broker-dealer role, and John will give you a deeper dive into the fund law, and then we will have Ken, who will give you all the fun information about fund practice itself. So I turn your attention to our first slide, which just gives you a legal overview and basically tells you how we get to this fund space. So we're starting with the basic premise that, so why are we, when we're talking about real estate, why are we talking about securities at all? Well, because of the way these are sold, and we have interests in real estate investments from which you're earning a return because of the work of someone else, through the development of the law over the years, it's been deemed that these are securities that you're buying. So what we do is we look for, in this space that we're working in here, a way to do this offering without becoming a real estate investment trust or something that's so large that would be cost prohibitive to manage, because that's not the work that we want to do. So what we do is we find a way to have these funds out there where you can sell to your investors and do the type of work that you want to do and not have to register it. Is registering so terrible? No. But it is cost prohibitive. So the first law that comes into play is the Securities Act of *33, and the basic premise is everything is a security, you've got to register it, unless you find an exemption. So what we're working with here is an exemption that we help you stay within in order to create these funds. Now, is that the end of it? No. Because what we're doing is we're pooling investments from a number of people, so there's another act that comes into play, and that's the Investment Company Act of 1940. And what our expertise is knowing those laws so well that we help you create your product so that you don't come within the definition of what needs to be registered. So you have the private placements, then you have a private fund, and within that scope, you have real estate funds, which is the focus of our talk today. Now, just to keep in mind, even though you're exempt from registration, you are still subject to what's called the anti-fraud provisions of both the federal securities laws and the laws of any state where your operations happen to be located. So even though you don't have to register and spend all the money that's associated with the registration and have all of the affiliated service providers, you do still need to be very careful how you run the operations. And that's some of the work that we are here to help you navigate so that you know exactly what you need to do. So within that context, so now you see that we have the overall framework, and you'll see a couple of other laws listed up there. You have the Securities Exchange Act of 1934. Some people work through registered broker-dealers. You have the Investment Advisors Act of 1940. Some of you will actually be registered advisors, and a lot of that will depend on where you're located. But again, whether you're registered or not, you will still pretty much have the same obligations with respect to how you manage your fund and how you relate to and sell your shares to investors. So I'm going to introduce Vanessa Torres. Vanessa is an investment fund attorney. She practices in the area of investment fund formation and securities laws. She's here in the Los Angeles office. And prior to joining Capital Fund Law Group, she worked as in-house counsel on the due diligence team of a real estate securities broker, where she was also involved in selecting real estate funds to be offered through the broker-dealer sales platform. Welcome, Vanessa.
Thank you. Hi, as Beth Ann said, my name is Vanessa Torres. I joined Capital Fund Law Group last year. Prior to Capital Fund Law Group, I worked at a securities broker-dealer. We mainly sold real estate securities, so fractional interests in real estate, and we sold funds, 1031 exchange properties and portfolios, and very rarely non-traded REITs. And I worked in the due diligence department. So if you were a fund manager and you wanted to use the broker-dealer to help you raise capital, you would send your offering documents to due diligence, me or other people in due diligence. We would look at your offering documents. We would have questions for you. We might ask for additional information, and then we would take that information, present it to our management, and then from there decide whether we wanted to offer it to our clients, our accredited investor clients. And so that's a very crucial piece for people who are looking to raise capital. So I'm going to start off with the next slide. What is a broker-dealer? This is just a formal definition. A broker-dealer is a person or company that is in the business of buying and selling securities. The people who work at the salespeople actually who work at the broker-dealer are technically called registered representatives. And these are the people who have relationships with accredited investors. They often have people that they've known for years, so they have those pre-existing relationships, and they sell various products to the investors, provided that those products have made it through the due diligence process and meet the broker-dealer standards. Each broker-dealer is different. Each is its own company and may have different things that they're looking at or quirks, but I'm just going to give a broad overview of the FINRA regulations, because those will generally apply to all of them. So next slide. Why is this topic important? Well, many of our clients are just starting out, so they may be raising capital from friends and family and have the eventual goal of reaching out to broker-dealers and getting their offerings sold through that platform. But it is a higher bar to meet because the broker-dealer doesn't know you as well as your friends and family and contacts. So that's why they have this due diligence, which is really a vetting process. Next slide. I'm not going to go through all the slides. I'm going to keep this brief, but this slide, what are the BD's DD requirements, is an overview of things that FINRA has specifically mentioned as things that the broker-dealer needs to look at when they're looking at your private placement offering. There are no ironclad rules, so it's not like a check the box and you're done with due diligence, but these are some of the specific things that FINRA has mentioned that should be part of the broker-dealer's due diligence process. So the broker-dealer needs to conduct a reasonable investigation of the issuer and the securities recommended. So that's an investigation of you, the fund manager, and then also your offering, the offering itself. They also need to determine suitability of the investment for the particular investor. They also need to verify any claims you make about your offering, follow up on any red flags. They have a duty to know the product, so it helps if you target a broker-dealer that's in your industry, because if they're typically dealing with real estate and you were trying to sell them an oil and gas investment, for example, they don't have the experience to really evaluate that. So you'll want to target people who have expertise in your industry. FINRA also tells broker dealers to beware of what they call one and done market entrants, which is really an emphasis on what's the right word? If you're a newcomer and they don't really think that you're committed to that space or committed to your reputation in that space, they want to see people who are not in there who are just trying to make a quick profit, but people who are really committed to continuing their company and building up reputation and track record and things like that. So that's what that means. Really quickly, I'll just go really quickly over what a reasonable investigation is. Reasonable investigation includes, at a minimum, looking into the actual management of the fund, business prospects, so industry outlook, that type of thing, the actual assets that are being acquired. They'll want to see appraisals and property condition reports, any market studies that you have, citations to claims that any claims that you've made. You'll want to have some factual reference to them. Otherwise, you'll want to qualify that it's your opinion, not fact. And they'll also want to look at the use of proceeds of the offering. So any type of fees that are involved that are being charged to investors, that has to be disclosed. They want to know where the money's going, how you're being compensated, any fees to you. So that's a general overview of reasonable investigation. And then really quickly, I'm going to go to I want to go to the slide on suitability. So there's two types of suitability. There's the reasonable basis suitability and customer specific that the broker dealers they're concerned with both of those. And so when they're looking at your offering, they're going to want to first see if it makes their sort of basic threshold standards, and that's really the reasonable basis suitability, which was more what I was involved with. And then the actual salespeople who are selling these offerings to their clients, the investors, are going to be concerned with more customer specific suitability, and that's where they'll really look into the investors' net worth and their investment risk tolerance and things like that. That's where they'll really get into their individual client to make sure that your offering is suitable for their particular client. And these things are all important, because if they don't comply with these due diligence obligations, then they're in violation of the law and FINRA rules, which FINRA is regulating the broker dealer. So that's very quick overview. I didn't go through all the slides, but that basically covers the general things that the broker dealer is looking at. If you really wanted to get specifics, you'd probably want to go out and talk to broker dealers. But hopefully this will give you an overview of what what to look out for, what to be aware of when you start thinking about approaching broker dealers to help you raise capital for your fund offering. So I think you're presenting. Thank you.
Thank you so much, Vanessa. Whoops. Okay, thank you so much. So you are selling interests in order to support your real estate acquisitions. So we've got that security overview, and now Vanessa gave us the overview of the broker-dealer due diligence process that relates to some of the distribution and acquisition aspects. So now, since we are talking about the private offering space, there are also limitations on how you can get the word out that you're offering these interests for sale in order to buy your real estate. There are restrictions on how you market it, and there are restrictions on to whom you can market it. So John Lohr is going to join us now to give you a further overview and a further deep dive into what the next steps are. John is the managing partner of Capital Fund Law Group. He has spent his legal career focused on advising emerging fund managers, and he regularly answers questions regarding the jurisdiction and related issues throughout the United States and all over the world. He advises fund sponsors on all aspects of their business, from capital raising and fund formation to implementation of their business models. Prior to founding Capital Fund Law Group, Mr. Lohr practiced corporate and securities laws at a number of law firms, including in the private securities practice group, resident in New York City and Moscow offices of Bacon Gump, which is one of the largest international firms in the world. John.
All right, thank you, Vanessa, and thank you to those that braved the LA rain here and the traffic to make it here. On the subject of real estate fund capital raising, the type of investor that it's going to invest in a real estate fund versus an investor in a hedge fund, venture capital fund, other private equity funds, it is going to be in our experience, a different profile of investor, where some of the venture capital firms or quantitative hedge funds are looking more at a very specific way to create a high return, whereas hedge funds, et cetera, are really looking at larger growth. Real estate funds in general tend to be gearing towards the more conservative investor. And so with that, we're looking at how to raise capital for a real estate fund. And we have a number of broker dealers that we've worked with. A lot of this is simply private fund managers doing their own capital raising. Important that we limit who the fund management team is talking to and how they talk to their investors, and also satisfying the applicable wealth standards for investment. Now, the issue of whether or not a real estate fund is required to have a accredited investor versus a qualified client, which is a higher standard, the $1 million net worth versus $2.1 million net worth, has to do with the Investment Advisors Act of the specific state and the SEC. So starting, a investment in a real estate asset per se is not an investment in a security. An investment in a security is a specific type of regulatory oversight that is found under what's known as the Howey test, and it looks at whether there's an investment made with the expectation of profits to be gained from the effort of others. And so this issue from the effort of others is where we decide whether a given fund is a security, in which case you may be triggering the Investment Advisors Act and needing a $2.1 million net worth investor, or whether it's just an accredited investor. And there's a much wider funnel of potential investors in the accredited space. It really comes down to the expectation of profits from the effort of others. And what that means is, if you're investing in an asset that is purely real estate, then a pure real estate investment, a number of real estate investments, you're not going to worry about being deemed a security. However, most funds at a reasonable size start to do joint venture deals, start to do deals where they're bringing in other parties to participate and maybe paying profits. Sometimes there's a management company that steps beyond merely managing the property and really starts to impact the value of the investment. When that comes into play, you've got to consider whether the fund is investing in securities. And that's something that we can certainly discuss with you. For the most part, emerging fund managers, they tend to be larger at launch with a real estate fund than a hedge fund would be. Whereas you have a open-end hedge fund that has the ability of investors to make subsequent investors and make periodic redemptions, usually quarterly after a 6-month lockup. With a real estate fund, you're investing in an illiquid asset, and as such, the illiquid asset really needs to be done under a closed-end fund. And a closed-end fund requires that you do your capital commitment period, where you're raising capital before actually getting investment into the fund. And then after that period, you have a capital deployment. And a $1 to $5 million fund is not going to do much for a closed-end fund. A hedge fund can do that fine, and they get started, then they grow, additional investors come on. Well, with a real estate fund, you really need to have a larger base. We would say at the very floor, 5 to 10 million in initial capital. Now, you can get there right around 5, but the idea is this first fund needs to have enough assets under management to spread out costs and to justify the existence of the fund and to allow you to take diverse portfolio positions. And that tends to be in that range. The first fund is not the end-all fund. The way we'd structure a fund is to have multiple funds, and this first $5 to $15 million fund isn't going to be your magnum opus. You're going to start with a initial capital raise. A strategy we've seen work very well is to set your fund size slightly below what you would think is the estimate of what you can raise. So you're getting oversubscribed. And when you're oversubscribed and you are able to raise capital well within your threshold, 6 to 18 months is what we'd expect to see. If you can get all of your capital commitments within 6 to 9 months, and then tell potential investors that you're full, then that strategy does so much better than a fund that really swings for the fence and sets up a $50 million fund, gets 35, it's seen as a bit of a failure, a misstep, versus you set up a fund, set it at 5 and raise 7, and then within 2 years you're setting up your next fund. Then you've got some momentum. Because closed-end funds cannot be continually raising capital, what you do instead is you have a series of funds. What we generally would say is one fund every 2 years is in the early startup phase is a really good replacement for an open-end fund. And if you keep setting conservative numbers and oversubscribing, that's where we've seen most of our most successful clients end up. And then they're not constantly trying to raise capital within their capital commitment period. They're not pushing the 18 months. They're getting it done right at the beginning. The nuts and bolts of how to satisfy the various regulations can really easily be found on various white papers, ebooks, blog posts on our website. So I won't take the time to walk through that now. What I would like to do briefly is talk about another sub-asset type within real estate funds, and that is EB5. And so our firm has actually done a number of EB5-based real estate fund offerings where we act as securities counsel. And we have worked with one of the broker-dealers that's very active in that space, Yvonne Yu with Key West Investments, and I've invited her to come up and share her experience. We've been working together, I believe, since 2014, and fantastic at what she does. So I'm going to go ahead and pass the mic here just for a moment. I'll stand beside you.
Hi, my name is Yvonne, and I have a broker-dealer, a U.S. registered broker-dealer with a FINRA and SEC register. And then I work with John Law since 2013. And so in the last 2-3 years, and then I work mostly in EB5 arena. And so there's a lot of people ask about SEC wanted to get involvement in EB5 funds, but for broker-dealer, we cannot sell in out of the country. So how it works is I partner with those EB5 funds company, and so they sell to investor, and then we call and interview those clients and maybe meet with the clients to profile them to meet the suitability and also the KYC requirement, know your client requirement, so that to make sure that they all fulfill the SEC requirement. And also at the same time, we perform due diligence, same as Vanessa previously mentioned about the due diligence process. So we work closely with the SEC and FINRA, and hopefully that will work it out for the immigration part of the product. So I work closely with John Law, and we have many projects maybe coming as well. So if there's any questions, so yeah, feel free to let us know. Thank you.
Right. Thank you. I appreciate that, Yvonne. So when we're talking about raising capital for a real estate fund, like I say for any other asset class, one of the keys to successfully raising capital is keep a very focused investment strategy. As funds come to us, they often have a prime strategy that they're looking at as their main focus, and then they have several things they want to do. And down the road, there may be other opportunities to do different structures, and often the client will push to have all of those baked into the document so that they can be a fund that's everything to everyone. And the truth is that very large firms get to do that. In fact, they need to do that because they need to diversify. They need to pursue a lot of strategies at the same time. One of the real advantages of a emerging fund manager is that they're able to take advantage of very narrow specializations, very narrow focus that large firms either can't or won't do. And as part of our advice as we walk through to set up funds for our clients is to tell them to not worry about missing out on upcoming opportunities, because this first fund is one in a family of funds. Most of our most successful clients that have passed the $100 million threshold, they're operating many funds, and they're doing that with the appropriate size team to focus on the various structures. And one of our clients, Ken Cruz with Alpha Wave, is here today. And when I thought of who to invite, I immediately thought of Ken. Certainly embodies that focus that we have long recommended to our clients, of finding a narrow niche, getting started, and from that building your team, building your asset base to be able to then move on to larger offerings. So I'll let Beth Ann introduce Ken, and appreciate it.
Thank you so much, John. So we are here with Capital Fund Lawyers to give you all the help you need on the legal issues. But now we are very happy to welcome from the industry, Ken Cruz, who is the founding partner and CEO of Alpha Wave Investors, a private real estate investment platform. Mr. Cruz has deep knowledge of all aspects of real estate investment, asset management, and finance and operations. Prior to forming Alpha Wave, Ken was CEO and director of Sunstone Hotel Investors, a $5 billion total enterprise value publicly traded REIT traded on the New York Stock Exchange. Prior to that, he was vice president with Host Marriott in corporate finance, and he has held a number of board seats in the industry and has also served as a director of real estate industry trade associations. Welcome, Ken.
Thank you, Beth Ann. I appreciate that. Thank you, everyone, and thank you to all of you online. As John and Vanessa and Beth Ann appropriately pointed out, it's a great to have backup like this who really understands the SEC regulations and the rules of the road in terms of what we can do and cannot do as fund managers in this space. So thank you for having us here today. Before I get going, I should point out, as a real estate guy, it's typically a red flag when you come to a law firm that you're working with and they have views as nice as what we've got right here, and access to a conference room that's on the 25th floor of such prestigious real estate. But it usually means one of two things: either it's a very, very good firm, or they charge way too much. And in my experience, I think it's the former, not the latter. So anyway, thank you for having me here today. I think we've got some slides, although I don't see them up on the screen. So if we can just click through real quickly. What I'm planning to do today is talk to you a little bit about our history as a private equity manager. We started Alpha Wave Investors in 2015, about 3 years ago. As was mentioned, oh, thank you very much. As was mentioned before, my entire career prior to this was in the public company side. So I think I come to the private equity world with a little bit of a leg up in terms of understanding compliance rules, understanding the need for full disclosure for our investors. And I just wanted to echo some of the comments that were made earlier in this process. All that is critically important. It's probably even more important as those of you who are contemplating or are on the early stages of forming and building real estate funds. You've really got to pay attention to the rules and make certain that you're over-delivering and under-promising when it comes to what you're doing, and that you've got all the I's dotted and the T's crossed as it relates to documentation. Before I get into our organization, we do have some legal disclaimers that are included on our site. So sticking with the rules. Please do familiarize yourself with those disclaimers. At Alpha Wave, our company was formed, as I mentioned, in 2015. We are very focused on two forms of real estate. Hotels has been my career focus the entire time I've been in the professional world. Multifamily is one of our other partners' strengths and passions. And so we've really stuck with those two pieces of the puzzle. Interesting sidebar, we're here in Century Plaza today. prior to forming AlphaWave, I was CEO of Sunstone Hotel Investors. And one of my favorite deals that we did was the Century Plaza Hotel next door to where we're standing here. We're all real estate people, or most of us are real estate people, so you appreciate the value of that street corner. We acquired it in 2005 for $293 million at a time when this market was full of sound and fury. Brand new CA offices were being built next door. There was all sorts of stuff happening here. And Century Plaza was a pretty tired old building, so we got it for a very good price. We engaged a third-party manager, got some guarantees of about $27 million from Hyatt when they came in to operate the hotel. And about 2.5 years later, we sold the property for $366.5 million. Pretty darn good returns on a deal that, from the outset, most people said, "What are you, crazy? Why are you paying that much money for that old tired battle axe there in Century City?" And as we move forward now, it's being redeveloped into something even more grand than what it was before. And that I think really does a good job of describing what draws me to real estate in the first place, and the types of deals that we're doing today. We're trying to find the high-hanging fruit as investors, find the deals that have a story that others aren't seeing, and that we can then maneuver into and get subsidies or guarantees or other forms of credit in the transaction that will further enhance the potential returns. So this first slide, if those of you online can see it, just talks about our mission. First and foremost, we're here to create value for our investors. I think as any firm, if you forget that value, if that's not your first value, you're probably in the wrong business. You've got to look out for your investors first and really act as a fiduciary, even if you've got an SEC exemption that somehow says you're not a fiduciary. You should think in those terms. I've already mentioned some of our background. We started, as I mentioned, a little bit over 3 years ago, and we've done a number of deals so far. We've elected not to go with the fund model initially because while we have a very good track record in the public company world, hadn't really established a track record in the private company world. So you'll see that while I was CEO of Sunstone, we grew our equity market cap from just about $1 billion when I started to over $3 billion when I left in the spring of 2015. And our investors enjoyed about a 38% IRR during that time period, which exceeded that of our peers by roughly 10 percentage points each year. It's a fact that I'm very proud of. I'm also proud of the fact that we deleveraged by more than any of our peers and that we were consistently named one of the best workplaces in Orange County. And I think all of those qualities and statistics speak to kind of my philosophy as a business leader. It's not always about profits first. It's about doing the right things. It's about running the business in a strategic way. And if you're disciplined about how you do those things, typically the profits come as a byproduct of that, not as a first and foremost objective. To date, we've done about 18 different asset transactions. Some of them were coupled into multi-asset deals. We've had reversions on 4 of those, with IRRs ranging from a little bit over 15% for a fairly conservatively leveraged portfolio of 4 different apartment buildings in Las Vegas, to over 100% IRR on a transaction that was much more opportunistic, where we came in, found great assets on very good street corners that were clearly misoperated, and we were able to come in and change the rent rolls, change the positioning of those assets, and then fairly quickly turn those around to sell. We're certainly not here to promise to any of our investors that 100% return is a likely outcome. In fact, we're more likely to talk about returns in that 15% range as being target. As John mentioned earlier in the conversation, IRRs are typically much lower in real estate because you also typically have lower betas on or lower variability on your investments, lower risk. You've got an asset that underlies what you're purchasing. IRRs on hotel deals tend to be a little bit higher because you are in fact investing in an operating business. So you'll see a little bit of a higher IRR target on our hotel deals. I've got a little bit of detail on our investment process. Again, we focus a lot on the process. We've spent a lot of time trying to be more of a tortoise than a hare over the first 3 years of our existence.
Sorry, can we just switch mics?
Oh, sure.
We're just having issues with this one. So for our online people, if you could just mute this one.
Yes.
Sorry about that.
Can you guys hear me now? Great. Sorry about that. You want me to start over from the top? I hope I didn't waste that great joke at the beginning. I'll spend a moment on our investment process here, which is I think relatively common sense. We are focused on what we believe we're good at, and also about what we're passionate about. So you've heard John talk about a lot of guys get out there and they want to have opportunities to do a broad range of different investment types and pursue a broad range of different investment structures, especially when you're going forward with setting up a long-term fund. We've been able to shift away from that initially by doing most of our deals as LLC transactions, where we match fund our capital with each of the deals, rather than having a big open-ended fund that has a mandate to acquire buy and sell multiple assets over time. I'll talk in a moment about our strategy going forward, which will be to in fact raise some larger scale funds now that we have a track record on the smaller LLC side. But our initial plan by design was to go with smaller deals that were independently funded. So that's kept our focus again on hotels and multifamilies. We tend to seek out the high-hanging fruit. We don't look for the deal where the broker has broadly disseminated a transaction and says, here's the price, who wants it, and get out there and compete with a number of different players on a published price. Nor do we typically go out and look to compete in spaces where we know others have a cost of capital advantage, or where they've got a market knowledge advantage over us. So we find the high-hanging fruit where we feel like our track record, our relationships, our knowledge of the market, and our access to capital gives us an advantage, not a disadvantage. And I'll talk about a few deals that fit within that bill very well recently. Even with that, we tend to measure twice and buy once. So we're always looking for deals where the math works, it fits through our screening criteria, but then we figure out, what did we miss? You know, there's always something that you've missed, and make sure that the deals still fit within our screening criteria once we've measured twice, so to speak. We're always looking for deals at a discount to replacement value. We don't do development, so when we buy an asset, we want to look at what would it cost us today to build this property? Have market characteristics changed from the date that this was built, where it's no longer warranted at that value? If it is, then typically we can check the box that the discount to replacement value is additive to the investment. We buy broken assets, either with the wrong management, the wrong brand, the wrong capital positioning. We look for proximity to demand generators with clear upside potential. And as our name implies, we tend to be cycle appropriate. Hotels in particular are very economically sensitive. And as a result, you tend to see values of the hotels peak and potentially even get overvalued as the economy continues to strengthen during any period of economic recovery. And then hotel asset values tend to drop off more precipitously than other forms of commercial real estate when the economy also softens. And that's just a natural tendency with hotels. If you understand that cyclical wave and the higher, as I used the term before, higher beta that hotels have, that can be a big strength in your investing strategy. And that's exactly why we're looking to raise an actual dedicated fund around hotels now, because we feel like we're late in the cycle. And we believe that there are going to be opportunities to acquire distressed assets in the next few years as the cycle turns and we experience what inevitably will occur. We haven't seen the last of recessions, and when the recessions occur, that's actually a great time to be proactive in acquisitions. I'll skip over most of what's on this page, but this does provide a little bit more detail. One note I wanted to touch on very specifically is reporting. You know, as I mentioned, I come from the public company world. One of my partners, David Sloan, was our former general counsel at Sunstone for many years, so he too comes from that public company legal perspective, understands the SEC guidelines and rules. And as a result, we understand how important it is to provide a robust and accurate degree of transparency for your investors. So we try to report out well beyond what's required under our filings. I think I mentioned this before, but we typically do our deals under Reg D and then the 506C exemption. So our investors are all accredited investors. We don't advertise our deals. we use our existing network for our initial deals. That'll change when we go out and do our funds that I'll talk about in a moment. So let's just spend a moment before we go to Q&A with a couple of representative investments. First asset we bought last year in a small market adjacent to a very vibrant market, Redmond, Oregon, which, if you know Central Oregon, it's next to Bend, which is one of the fastest growing cities in the United States, and it has been for several decades. Just a gorgeous natural setting. The airport that serves Central Oregon is in Redmond. The fairgrounds and some other big demand generators are in Redmond, but Redmond has kind of been the kid brother to Bend for many years. That's all changing now. So we were able to acquire a small deal in that city for just under $2 million. So we're talking from the $293 million purchases of Century City down to high-hanging fruit that is like this Redmond hotel, where it's $2 million to buy it. Had great retail already on the ground floor, historic structure, and you had a city that's got deep pockets and an abiding desire to reactivate their downtown core. And this hotel sits on Main and Main. So we were able to negotiate an incentive package from the city that, when coupled with our tax credits that we'll get and other benefits, equates to about $1.4 million in total. And of that is almost $670,000 worth of a forgivable loan, straight capital from the city. So we bought down our basis. We basically got the hotel for free, and now we're having a whole lot of fun repositioning that and creating something that the market is deeply in need of in terms of the product. This is a picture of the hotel. It's actually a beautiful structure built in 1929. As you can see, the ground floor is all occupied with retail. These are some inspirational renderings for what we're doing on the rooftop. The rooftop itself has beautiful views of the surrounding Cascade Mountains. There's no other rooftop bar in the market, so we're adding a rooftop bar as well as a number of different retail and food and beverage locations on the first floor. And we expect to have the F&B bar and a club and another food and beverage setting on the first floor delivered this summer, with the hotel opening next fall. The next one is the Salishan Spa and Golf Resort in Glen Eden Beach, Oregon. It's 205 keys. It's on 158 fee simple acres. It's got a world-class spa, 36,000 square feet of marketplace, an 18-hole golf course, 16,000 square feet of high-quality meeting space. John, I hope you'll conduct your next meeting there. It's a perfect location for this kind of thing. That was a real estate-owned deal, so it was effectively held by a receiver for many years. Prior to being in receivership, it was languishing in a pre-receivership state. So ownership had done very little in terms of caring for the long-term strategy of the asset. They spent a lot of time cutting costs, cutting services. They did put a fair amount of capital into the deal. And so the physical product is in wonderful shape. It's just that the reputation and the service level had both declined meaningfully, as the prior ownership just didn't, the receiver just didn't understand the hotel business. Because it was an auction, we were able to get into the deal with very few other competitors. It was a big enough deal that kind of mom and pop investors wouldn't have been competing in this space. A little bit smaller than most of the public companies would have been looking for. Certainly a specialized operation. And because of the auction format, where you've got to go non-refundable the second you win the auction, you don't get to negotiate purchase and sale documents, and you're forced to close in a very short window. This too didn't appeal to a lot of more risk-averse investors, and yet it fit perfectly within our high-hanging fruit strategy. So we were able to win the auction at a very attractive price, about $78,000 per door, $68 a foot, so significantly below replacement costs, as I touched on. We raised about $25 million in total capital around the deal, as we're doing a number of improvements to the property in advance of next season, and we're targeting kind of a mid-20s to mid-30s IRR. There's a picture of the asset. It's a beautiful construction architecture style of, it's called Northwest Modern. John Storrs was the original architect. This is the spa. It is truly a world-class spa and location, just completely under-marketed and underappreciated. Some renderings, we're using a local landscape company called Lifescapes here out of Newport Beach, California, to rework much of the outdoor space there, and great interior designer as well to rework much of the interior. We're adding what we call glamping, which is high-end tents that people pay a fortune to stay in, and it's worth every penny. It's just a wonderful experience. And a whole bunch of other recreation features, including ropes courses and eco-adventure facilities, etc. So that deal as well is very exciting. There's a whole creative aspect to that we think will garner great returns for the investors. It's also very engaging for us as the sponsor to be involved in something like that. And the last deal, and this is one that we're going to be raising a fund around both the brand and then most likely on the real estate side as well, is something that we've branded the SCP Hotel in Colorado Springs, Colorado. We acquired this hotel last spring as one of, and it was truly, in my opinion, one of the worst hotels on the planet when we bought it. It had, if you look at TripAdvisor, if you want to be entertained and horrified at the same time, that was the place to go. I always stay at our properties before we acquire them. I actually checked into this one and checked back out before we bought it. I would not stay there. But it was great in terms of the bones. Very large footprint, over 100,000 square feet, 176 keys, 2 swimming pools, tons of meeting space. It was just a rat's nest and very poorly run property. So we bought it for an incredibly low price, given how strong that market is, of $3 million, which is only $17,000 a door. We're in the process of putting about $6 million into the deal, and we've raised around $10 million around that transaction. And again, that's looking to be in kind of mid-20s to mid-30s IRR. Here's a picture of what I should have got the before pictures in here. This is a picture of what the hotel will look like when we're done from some of the exterior corridor rooms. This is the SCP brand logo and an indication of kind of what the look and the feel of SCP is, which SCP stands for Soul, Community, and Planet. It's a brand that none of the other big brands have with these types of values. Soul is personal wellness. Community is creating spaces where individuals can congregate and feel welcome and do work or socialize, have a beer, whatever. We're creating an environment that's highly welcoming and clearly non-corporate. It's sort of your countercultural, handcrafted hotel brand, if you will. The P stands for Planet, so there's a huge green aspect to it where we're adding 100 kilowatt solar array to the roof. We've added all kinds of water conservation features. We're using low VOC paints and recycled materials throughout on our renovation. So the end product's going to be something that's truly unique in the industry, and it's something that we believe ultimately, in a actually relatively short order, we'd like to grow fairly quickly. Here's a rendering of what the lobby will look like. Just great seating area, very accommodating, living walls, and great lighting and so on. And some more pictures of the inspiration for the property. As you can see, a lot of natural materials, and we're trying to avoid anything that might look like a typical branded hotel, a Hampton Inn or a Courtyard hotel. And our view is that we'll be able to draw off the more creative class component of demand for those hotels to come stay in this type of a property. We'll be doing some murals and so on and so forth. So those are the types of deals we're looking at today. I chose to talk a little bit about the transactions that we're doing, largely because, as I was talking to one of you earlier, we do feel like we're late in the cycle. We do feel like we need to look for these kind of creative, high-hanging fruit deals that are non-bulk, that require a fair amount of creativity and attention to detail, but when executed correctly are likely to generate very strong returns, in spite of the fact that if you look at the overall trends in the hotel industry and commercial real estate in general, you are seeing some late cycle plateauing going on. So those are the kinds of deals that we feel are pretty good track record builders. And with all that, we feel that we've now got a good track record as a private company that corresponds very well with the track record that we've got as public company executives. That puts us in a good spot to go raise a significant amount of capital around the next upcoming opportunity in the down cycle. Hopefully that doesn't occur next year or the year after, but we do feel it's appropriate at this time to raise capital around that. So I can open up to questions for people in the room, and I don't know if we have a means to get questions from people on the online.
Great. We actually have a first question from our online listeners. One of them is from Jerry McCohey, Managing Director with Epic Community Impact Fund, and he's wondering, what is your strategy for raising capital for real estate funds with tax credits and/or tax incentive investments attached to the fund?
Yeah, good question. I'd kind of characterize that into more broadly our strategy, as I talked about, is to acquire assets where tax incentives, where municipal subsidies, where other forms of enhancements to the overall return are available. So I'd tell you that while kind of taking off of one of John's earlier comments, we'll provide certainly provide the ability to do that in our fund documents, and we would look for that as a component of our strategy. We'd also probably not go as far as stating that we will always look for deals that have those. Any number of deals that we've gone forward with are not incentivized by those publicly available funds, but rather have other enhancements that work to our favor. Any other questions?
I have a question.
Yes.
So we're talking about the nearly $300 million deal.
Yes.
And then we have the $3 million
Right.
deal, and in between, the 11 million, 16 million. When you go out and look for investor money, do you tailor the minimum investment to the type of deal you're doing, or do you just look for more or fewer investors when depending on what you're looking for?
Great question. So we find that I kind of characterize it simplistically as three different pools of prospective investors. So from my days as a public company CEO, got a pretty good series of relationships with institutional investors, most of whom are not interested in getting involved in the deal, given the limited return on resources, unless they're going to be putting in 50 million or more of equity into a transaction. So that kind of puts you in those $300 million and up deals. There's another group of larger family offices and more regional players who will go with the smaller checks, but even then they're probably looking between 10 and 30 million for an equity check. So for the smaller deals like the ones I talked to you about today, as I mentioned, we do the 506C offerings to accredited investors. We don't advertise the deals, and so that all comes through our network of quote friends and family for those initial deals. We have dropped the initial investment size based on the risk profile of deals or the overall size of the deal. Taking down all of the equity, and that's in part also because we want to broaden out our universe of we think we've got a good little model here. We want to now build that brand and that track record with a broad group of investors who would be interested in working with us. And in some instances, that would require taking what would otherwise be a $250,000 minimum or a $100,000 minimum down to something like $50,000. Great.
Okay, great.
Thank you.
Thanks, Ken.
All right. Thank you, everybody. Appreciate it. Drive carefully.
All right. Well, thank you, everyone who came and participated with us. There were a number of questions that were sent to us about the legal setup and some of the more technical questions, which I will answer subsequently via email and make sure everyone is included on that. We have additional webinars that we're planning in coming months, and so stay tuned to that. But appreciate you coming out. Also, if anyone has questions for Ken subsequently, reach out to us. We'd be happy to forward that on to either Ken or questions for Yvonne. Thank you.